What's up, strategic investors? We're here to bring you breaking news regarding cryptocurrency and macroeconomics in a simple way that's easy to understand. This is one of the most volatile periods of history in the last several hundred years. Economics and cryptocurrency has never in history been as important to understand as it is today. We're looking to build a community of some of the brightest minds in all of finance. Asset management is like a game of chess, and we're always looking to stay one move ahead of the competition. Subscribe to our channel to become a part of the most comprehensive upcoming communities in cryptocurrency and economics. So enough with that, let's get to the content you all came here to see. In this video, we're going to be comparing the European monetary policy to the United States' monetary policy. There's been a lot of volatility on the United States dollar and the euro pairing. So I thought it would be a good time to dig deeper and see why that is happening. And you can see from this article right here that it was just published February 7th. And it's regarding a statement that Christine Lagarde with the European Central Bank, ECB, just put out. So she came out and she said that there is no need for big ECB tightening as inflation to hold at target. And then there's some pretty interesting statements if we scroll down here. So here it says, there is no need for big monetary policy tightening in the Eurozone as inflation is set to fall back and could stabilize around 2%, European Central Bank President Christine Lagarde said on Monday. Pointing to mounting inflation risks, the ECB opened the door last week to an interest rate hike later in 2022 and said that a March 10 meeting would be crucial in deciding how quickly the central bank would wind down its long-running bond buying scheme, a cornerstone of its stimulus efforts. So you can see just from this, the European Central Bank is a lot more dovish than the Federal Reserve in the United States. They don't think they're going to be considering an interest rate hike until later in 2022, and they're only going to be considering how quickly the central bank winds down its bond buying scheme on March 10th. But the Federal Reserve has already been doing that for quite some time now. And then if we scroll down here, responding to sharply higher yields for debt on the bloc's periphery since Thursday's policy meeting, Lagarde said that the ECB is ready to intervene if needed. We will use any tools, any instruments that are needed in order to make sure that our monetary policy is properly transmitted throughout the whole euro area to all member states, she said. So you can see here that she's even coming out and saying that she's ready to reconsider the unwinding of the bond buying scheme or the interest rate hikes later in 2022. The Federal Reserve, on the other hand, is signaling that they're probably going to be doing about 6 rate hikes this year. They also hope to be completely done with the tapering by March. So let's come over here and take a look at some of that in detail. You can see from the header up here, the Fed will double pace of tapering. And this was updated on December 15th of 2021. So, in his post-meeting press conference on December 15th of 2021, Federal Reserve Chair Jerome Powell announced that the Federal Open Market Committee, the FOMC, will double the rate at which they reduce monthly asset purchases, a process known as tapering. Specifically, the Fed will reduce its monthly purchases of U.S. Treasury securities by $20 billion each month and its purchases of U.S. agency securities by $10 billion each month. The upshot of this is that the Fed will stop adding to its balance sheet by March 2022, rather than mid-22 as previously forecasted. So you can see that we are already tapering and we are picking up speed, and we are quite a bit more hawkish in this sense than the ECB. So let's come over here. All right, so this article, the header is the ECB's Not sees first interest rate hike in the fourth quarter of 2022. And this was posted on February 6th of 2022. And then if we scroll down here, you can see that the central bank president and a member of European Central Bank's Governing Council said on Sunday that he expects the ECB to raise interest rates in the fourth quarter of this year. So that's pretty dovish compared to the Fed, which we can look at right now. So this article right here was posted January 26th of 2022, and the header reads, Fed likely to hike rates in March as Powell vows sustained inflation fight. So if we scroll down here, the Federal Reserve on Wednesday said it is likely to hike interest rates in March and reaffirmed plans to end its bond purchases that month in what U.S. Central Bank Chief Jerome Powell pledged will be a sustained battle to tame inflation. So we're already talking about hiking interest rates as early as March, and they've predicted that it could be up to 6 times throughout the year, whereas the ECB doesn't even plan on doing the first one till the fourth quarter of this year. So that means that the Federal Reserve in the United States is actually a lot more hawkish in this sense than Europe and the ECB. So if we move to this webpage over here, this is another perspective also. So another item high on the agenda will be the tensions between Russia and Ukraine, including any potential implications. So if tensions deepen, resulting in disruptions in energy supply to Europe, we expect the ECB to turn increasingly dovish, focusing on the impact of growth and financial stability despite likely higher energy inflation in the short term. And if you remember from back here, we read that quote from Christine Lagarde that said that she's ready to intervene in the markets as needed, whenever needed. So if there is anything such as this that goes on, she's ready to completely flip the script and do a pivot, kind of like Powell did back in 2019. All right, so let's take a look at how this is affecting the currency markets and the pairing between the dollar and the euro. As I mentioned before, there's quite a bit of volatility. So let's quickly take a look at what the DXY is made out of, or composed of. You can see that the euro has a weighting of 57.6%. So it does make up half of the DXY. And then you have the Japanese yen down here, which is just over 13%. Then you have the British pound, which is almost 12%. Then you have the Canadian dollar, which is just over 9%. And then you have the Swedish krona, which is 4.2%. And then the Swiss franc, which is 3.6%. So it's really the euro, the Japanese yen, the British pound, and the Canadian dollar that really make up the majority of it, and mainly just the euro. Let's take a look at the DXY chart. All right, so this is the DXY chart, and you can see that we've had quite a bit of volatility as of recent, and we've actually been in a pretty bullish trend as of the last 6 months to a year. But I quickly wanted to point out how this relates to Bitcoin. So this green line right here is going to be January 14th, and this red line is going to be January 31st. So this green line is the beginning of this big move up in the dollar, and this red line is going to be the beginning of this big move down in the dollar. So let's just come over to Bitcoin really quickly. All right, so you can see that same date right here, which was the move up in the dollar, was the beginning of the move down in Bitcoin. And then as the dollar started to move back down, that's when Bitcoin started to move back up in a meaningful way. And Bitcoin and the US dollar do have a negative correlation, as Bitcoin is priced against the US dollar in this chart. So as the US dollar does better, that would theoretically put pressure downwards on Bitcoin, and vice versa. As the dollar does worse, that is more incentive for Bitcoin to go higher. So you can see that the dollar probably is playing a role in the volatility in the Bitcoin markets at the moment. So let's go back to the currency chart and look at the DXY one more time. So you can see that the DXY right here did not make it all the way back down to this breakout point. So it is showing a little bit of strength right here. And we can look at the euro really quick. And as we saw on this webpage, it does make up over 50%, almost 60% of the DXY. So on this chart, you can see that we actually did come back down to that point where we actually came back down to here also. So that would be this point right here. So the US dollar euro pairing is looking more bearish than the DXY. So that suggests that the rest of the currencies that make up the DXY are more bullish than the US dollar euro pairing. So let's come back over here one more time. And you can see from this chart that it's also had this incredible amount of volatility. We had this huge rip down, and then we had this huge rip up, and we've had this huge rip down. So I don't think that price action is sustainable for too much longer. And really quickly, we can come over to the US dollar and Japanese yen pairing, just as an example to show what I was talking about with the other currencies that make up the DXY looking a little bit stronger. And I was playing around with this chart a little bit just to get an idea of what's going on. And it does look like we are in something of a diamond pattern, which if this does break out higher would just suggest a pretty good rip up for the US dollar against Japanese yen. But this pattern can also suggest a breakdown to where we came down from. It's really not that informative at the moment, but let me delete that real quick. All right, without the drawings on there now, you can see that this chart is actually quite a bit more bullish for the US dollar than the chart that's paired against the euro. So looking at this chart again, we can see that this is the US dollar paired against the euro, which means that this dump right here means that the dollar got a lot weaker against the euro. But as we can see from all of these web pages that we just looked at, the monetary policy in Europe is a lot more dovish than it is in the United States. This means that monetary policy is actually likely to be a tailwind for the dollar in the near future, which means that the dollar is more incentivized because of all of this to become stronger. And that means that anything that is denominated in dollars is more likely to become weaker. So if you're pairing Bitcoin against the dollar, or if you're pricing stocks in the dollar, or whatever asset it may be, as the dollar goes up, that is a headwind for whatever asset is priced in it. So it looks like to me we just came back down here and tested this as support, and I don't really see the reason for it to go any lower than this, considering what we just talked about with the monetary policy between the ECB and the Fed, which means that the DXY is likely to continue going up also. And then on top of all of this, we also have another situation developing with fixed income markets. So if we come over here, we can see that this chart is going to be US 2-year Treasury yields. So you can see that this chart has been on an absolute tear over the last year. And it's not just the treasuries and the yields on the treasuries that are going sky high. If we come over here, you can see that this is the US high yield index effective yields. So this is going to be junk bond yields. And you can see that we've come down pretty low. And as of recent, right here, August of 2021, they've started to move higher, and they're doing so pretty fast. And let's just take a look at a couple examples of history when they've rose quite a bit in a short amount of time. We have March of 2020. We have November of 2018, which we did have a pretty good correction. I believe it was actually over a 20% correction, but don't quote me on that. It was around that. I just remember they were talking about getting in the vicinity of talking about a recession. And then if you come back here, there's another one in 2016. And then this big one over here, you can see was 2008. Anytime these yields go up, it really puts pressure on the economy. And you can see it's all markets. So this is going to be corporations and businesses. So all of these companies that don't really have that great balance sheets, and they're not bringing in good cash flows or don't have good profit margins with the inflation, that's going to become a real problem the higher this goes and the faster it goes. And then, of course, you have the US government, which has its own problems. We just put out a video regarding that, so go check that out if you're interested. But all in all, I don't feel like this is the best environment for assets. I think if you're real with yourself about all of the information that is going on around the world, it brings you to a conclusion that things are likely to get worse before they get better. So right now, I think the thing to be watching for the very near term is going to be seeing how the euro and the US dollar pairing plays out. Specifically, if it can hold this support and how quickly it recovers back to these levels up here. If we start seeing it move up quite a bit faster, that's going to be pretty concerning also. And really the key takeaway is that we are starting to see a divergence in monetary policy between the Eurozone and the United States. Pretty much ever since the pandemic hit, the European Central Bank and the Fed have been pretty similar in their decision making and the policy adjustments that they made along the way. But I would say that this is definitely an exception to that, as the ECB is considerably more dovish at this point in time than the Federal Reserve. So I definitely think this is a situation that is worth watching and paying attention to over the near term, and it really could develop into something pretty interesting going forward. So with that, I think we will wrap up the video. Alright everyone, thanks for watching. We hope you all found this content valuable. If you did, like this video to let us know so we can continue to put out similar content. If you have any questions or comments, or if you have any suggestions regarding other topics you're focused on and would like to see us cover, just let us know in the comments below. And subscribe to our channel to become a part of the most comprehensive upcoming communities on all of YouTube. This economic environment only comes around once in a lifetime, and we're here to act like it. We're not here to talk you up. We're going to leave our emotions at the door and navigate these markets through the good and the bad. Keep in mind that this is not financial advice. This is more of a mastermind that we can all come together as a community and use each other's unique perspectives to better achieve logical conclusions. We really appreciate all of our team out there watching, and we look forward to continuing conquering these markets with y'all going forward. Until next time, stay one move ahead. Have a great day, everyone.